All right, so today we are going to start our next topic, which is the audit report. And this topic is very important for the exam, as you may have a separate question on this audit report. So before understanding what is audit report in detail, you need to understand where actually in the audit cycle it falls. So hopefully you remember the audit cycle, which we discussed in many lectures. The first stage of the audit was the planning. And then there was assessment of internal controls. And then there were actually two results. The system is strong or system is weak. So if the system was strong, we used to do less testing. And if the system is weak, detailed substantive testing. After that, there will be review. And the last stage is the report. So the planning, assessment of internal controls, and then less testing or the detailed testing, and then review and report. So as you know, we did the planning. Assessment of internal control is not part of your P7 exam because you have done that in your F8 exam. Then we did the substantive testing, we discussed the review, and now the last stage is actually the report, which we are going to discuss today. So this is your area, the audit report. Now, broadly speaking, there are two types of the audit report. Two types of audit report. Number one is unmodified audit report. And number two is the modified audit report. So unmodified audit report and the modified audit report. So now we are going to discuss, first of all, the unmodified. So unmodified audit report is simply where the auditor says or expresses that financial statements gives a true and fair view. This is also known as standard report. This is standard unmodified report. Like, we are not going to make any modification. We are just saying that the financial statements gives a true and fair view. You see, there are two types of the audit report. The unmodified report, that means where the auditor is going to express that the financial statement gives a true and fair view, and this is also known as the standard unmodified report. Now the next thing is the modified report. Now the unmodified report is where the financial statement gives a true and fair view. So that means when you talk about the modification, so there will be something else. Like something else. Something else means something other than the financial statement gives a true and fair view. So there are actually four types of the modified report. So qualified, and adverse, disclaimer, and emphasis or other matter paragraph. Now, before describing you these, that qualified, adverse, disclaimer, and emphasis or the matter paragraph, let me distinguish you between two other broad terms. Let me introduce you to another broad terms. Like when we're discussing, there are two types, report and opinion. Now, obviously, where is the opinion given? Opinion is given in the report, or where you are going to express your opinion. So obviously, you are going to express your opinion in the audit report. The auditor's opinion will be in the auditor's report. So we are saying that there are two types of the report, and we have said this is unmodified report and modified report. Now, obviously, this makes a clear sense. And similarly, when you talk about the opinions, so also there are two types, unmodified opinion, modified opinions. So when you say unmodified opinion will be in the unmodified report, modified opinions will be in the modified reports, simply. So opinion and the report. Why I have introduced these two terms to you? Because there is a concept which I'm going to express shortly. So when we say modified report, so I'm talking the qualified opinion, adverse opinion, disclaimer of opinion, and then there's emphasis or other matter paragraph. So again, I said that the unmodified report is that where the auditor expresses that the financial statement gives a true and fair view. That means this is the unmodified report, and this opinion that the financial statement gives a true and fair view is the unmodified opinion. Now, what is this qualified opinion? Obviously, this is something other than that the financial statement gives a true and fair view. So what is this? So if we say that except for this, except for this, now this can be anything, any qualification we are going to make. For example, I say except for inventory, rest of the financial statement gives true and fair view. Now I have expressed an exception, or I have made a qualification that, okay, except for the inventory, rest of the financial statement gives a true and fair view. Similarly, adverse opinion. Adverse opinion is where we say financial statements do not give a true and fair view. Financial statements do not give a true and fair view. Now, what is this? This is adverse opinion. Then you have disclaimer of opinion. When we say we are unable to express any opinion. So this is known as disclaimer of opinion. So these opinions are modified opinions. So when these modified opinions are coming in the report, that makes the report modified as well. So unmodified opinion means unmodified report. Modified opinion means modified report. So modified opinions or is like qualified opinion, adverse opinion, disclaimer of opinion. But there is this thing which is somehow different from the above three. I have written emphasis or other meta paragraph. So what do you mean by emphasize or emphasis? Like say for example, the emphasis is something which is like when we are trying to brought some attention. Like for example, we say, you know, when we are doing the preparation of the P7, do emphasize on the planning area. That means I am saying you to focus on the planning area. So where is this emphasis or other meta paragraph used? Now, the first thing you need to understand regarding this emphasis or other meta paragraph, I'm going to draw a line, is here the financial statements are true and fair. Everything is fine. When we are going to include this paragraph, everything is fine. So now when everything is fine, that means opinion is unmodified. Because when we are saying everything is fine, that means financial statements are true and fair. And when the financial statements are true and fair, then our opinion is unmodified. So why we have written this thing under the modified report? So remember this thing, that emphasis or other meta paragraphs are included within the audit report to draw shareholders' attention. Although we are going to discuss these two paragraphs in detail shortly, but let me just introduce you. So if, like say for example, there is an ongoing case on the company, and the company's expert says that the lawyers say that the outflow is possible. That means there are 10 to or 5 to 50% chances of the outflow. So that means according to the standard, the contingent liability should be disclosed. And the management have correctly given the disclosures. So they have given the disclosures correctly. But I want, being an auditor, I want the special attention of the shareholders regarding this issue. And when they are reviewing the annual report, when they're reviewing the audit report and the annual financial statements, maybe they skip that thing. So what we do, we put a special paragraph in the report to emphasize on matter, to draw the attention of the shareholder. So that is known as emphasis of the paragraph. And what is other matter paragraph? If something if you want to bring something to the shareholder attention and that thing is related to the financial statements, so we'll be including emphasis of matter paragraph. If something is other than financial statements, such as related to internal controls, related to management responsibility, any behavior, scopes, limitations, thing like that, then you will be writing other matter paragraph. So here the financial statements are true and fair. That is why opinion is unmodified, but we are bringing, or we want to draw the shareholders' attention. That is why we are including an extra paragraph in the report. So like when you fit an extra thing in the original car, then car becomes modified. That people say this car is modified because we have done some changing in it. So now you are actually bringing some changes in the standard report. You are writing an additional paragraph in that. So due to that, report becomes modified. So now you can actually feel why I have introduced this thing, that when you talk about the report, unmodified, modified. When you talk about the opinion, so unmodified and modified. So when you talk about the opinion, unmodified, it will be placed in the unmodified report. The modified opinions will be placed in the modified report. But except for this emphasis or other meta paragraph, because here The opinion is unmodified, but because we are actually adding an additional paragraph in it, that means the report becomes modified. All right, so we have discussed few things, and obviously this is going to continue in the rest of the lecture as well. Now, having said that, we will be discussing contents of unmodified audit report. The contents of the unmodified audit report. What are the contents of the unmodified audit report? So when you talk about the unmodified audit report, so there will be a title, and obviously the title, and then addressee, and the main thing which starts from the third point is actually the opinion. And then there will be the basis of opinion. Title, addressee, opinion, and the basis of opinion. And then after the basis of opinion, there will be material uncertainty related to the going concern. Material uncertainty related to the going concern. And then there will be key audit matters. And then other information. Then management responsibility. I'm just making short headings. You can see the details in your notes, in the report notes. I'm just going to explain these titles in a while, these headings in a while. But for the detail, you can just see the notes. Management's responsibility. So obviously I'm not going to write full report over here. I'm just making the headings in order to explain you what we'll be writing in each of the heads. And then auditor's responsibility, report on other legal and regulatory matters, and then after that it will be obviously going date, name, and signature, things like that. But we are more concerned with the main headings rather than discussing this date and things like that. So our main heading starts from here. So because these are the contents of the unmodified audit report. So that means opinion is where financial statement gives a true and fair view. Financial statement gives a true and fair view. Now, after the opinion paragraph, there is going to be the basis of opinion. Why you are expressing the above opinion. Basis of opinion means the reason why you are giving the unmodified opinion. So here the auditor will be explaining because we have gathered the evidence and the evidence is sufficient and appropriate. That is why we are giving this unmodified opinion. So there will be the basis. Now, in the standard unmodified report, the opinion and the basis of opinion are going to be the same in every report. Every unmodified report, this thing will be the same. Unless and until I'm going towards the modified report, where the modification may be due to different reasons. Like for example, if I'm giving the qualified opinion, and the qualified opinion is that except for the inventory, the rest of the financial statement gives a true and fair view. Now, my reason is actually that they have not recorded the inventory correctly. So I'll be explaining this thing in the basis of opinion. Similarly, it may be like except for the impairment, rest of the financial statement gives a true and fair view. So again, the impairment thing will be described in the basis of opinion. But when you are expressing the unmodified opinion, that means financial statement gives a true and fair view. So the opinion is going to be the same because this is standard, unmodified, and similarly the basis will be the same, that okay, we have gathered the evidence, evidence sufficient, appropriate. So the main wordings are going to be the same because this is the standard unmodified report. Now, after that, there will be material uncertainty related to the going concern. Material uncertainty related to the going concern. So we'll be discussing this as well. So first of all, what is going concern? Although you will be having a detailed video on this, but I'm just going to describe it for the report purpose. What is the going concern? And now the going concern is that the entity can continue for the foreseeable future. The entity can continue for the foreseeable future, and which is 12 months normally from the reporting date. Usually 12 months from the reporting date. All right. So when we are discussing the report, so there will be going concern, report implications. Now, the auditor has the responsibility to gather the sufficient and appropriate audit evidence regarding the assumption of the management regarding the going concern, because they are saying we can continue for the foreseeable future. So obviously their assumptions need to be tested, that whether they can actually continue for the foreseeable future. So there are four possibilities, or there are four things you need to discuss. And the first thing is entity is a going concern. They are a going concern. That means they can continue for the foreseeable future. But a material uncertainty exists. There is something which can affect the going concern of the organization, but a material uncertainty exists. But now they are going concern, currently they are a going concern, but there is something, if that happens, that can affect the going concern of the entity. And that is disclosed to the shareholders. That is disclosed. Now, number two is entity is a going concern. Now, you will be writing the same thing. Entity is a going concern, but a material uncertainty exists, but not disclosed. That is not disclosed. The third thing is assumption is inappropriate. Like they are not a going concern, but still they have made the financial statement on the going concern basis. Assumption is inappropriate. Number four, that insufficient evidence regarding the assumption. insufficient evidence regarding the assumptions. Entity is a going concern, but a material uncertainty exists that is disclosed. Not disclosed assumption is inappropriate, insufficient evidence regarding the assumption. There are four things. Now, let me discuss first one first. That entities are going concern, they find they can continue for the foreseeable future, but there's something which can affect the going concern of the organization, but that is disclosed. So if that everything is disclosed, that means report is fine, financial statements are good. So what we're going to do, we just include a paragraph in unmodified report, include a para in unmodified report which is related to material uncertainty. And in the unmodified audit report, we will be explaining that, okay, currently they're fine, they're a going concern, but the material uncertainty exists, and that is disclosed as well. So we'll be writing a pattern. You know, like this audit report is, the standard has been amended. And previously it used to be that when the entity was a going concern and the material uncertainty exists and they're disclosed as well, previously we used to include the emphasis of matter paragraph. So the problem with that was that because everything is fine and you are including the emphasis of matter paragraph, that is going to make the report modified. So there was a critics on that. So after that, they have amended this, that because everything is fine, they have given the disclosure. So this paragraph should be included in the unmodified report. So that is why material uncertainty related to the going concern is explained here in the unmodified report. We'll be discussing the other three implications later on. And then there is a key audit matters, CAM. So let's discuss this. CAM, key audit matters. Now, first of all, again, when the report standard was amended, this is a new inclusion. Now we can say this is new because now there are some years which has gone, but still, if you say the implication point of view, that so you can say this is something new, the practical implication. So key audit matters, also known as CAM. First of all, the first thing you need to understand is CAM does not constitute any modification to the report and opinion. CAM does not constitute any modification to the report and the opinion. So when you include a paragraph, when you include the CAM in the unmodified report, so with the inclusion of CAM, the report as well as the opinion remains unmodified. So this means report and opinion remains unmodified, because obviously this is a part of the unmodified report, so why it is going to constitute any modification? So no, it is not going to constitute any modification. When you include the CAM does not constitute any modification. The opinion and the report remains unmodified. The second thing, that this is included in the report to ensure more transparency. Like by the inclusion of this CAM, the shareholders get more useful information. The shareholders or users of report get more detailed and useful information. Now, what do I mean by this? So when there was no CAM in the unmodified report, what you used to do, you just explain management responsibility, auditor's responsibility, and the opinion. Even there was no basis of opinion. So what you're going to do, you are just giving them the report. Okay, this is our responsibility, this is your responsibility, and financial statement is true and fair. That's it. So obviously they have paid you too much for the audit. It is your responsibility to present some useful information to them, that what you have done and things like that. So the CAM covers or discusses three things. The CAM covers or discusses three things. The CAM will be covering three things, or explaining three things. First of all, risk of material misstatements, which is also known as the financial statement risk. Risk of material misstatements identified during planning stage, or during the audit simply, but more specifically the planning stage. So when we were at the planning stage, we said there is a risk that revenue may be incorrectly recorded. There is a risk they may not have recorded the warranty provisions. And there were some risk of material misstatements. So why we are explaining this to the shareholders, that when we are doing the audit, these were the material misstatements. So indirectly, you are saying to them, not directly, indirectly, when you write these risk of material misstatements, that the revenue was at risk, the provision was at risk. So indirectly, you are saying to them that, okay, when we were at the planning stage, we identified these risk of material misstatements, and then we gathered the evidence. Although we are not going to write this thing, I'm just explaining it to you, that when I'm writing the risk of material misstatement, indirectly what I'm saying to them, that these were the risks, and then I just checked it, that okay, these were only the risks, and this is not the case in the financial statement. Financial statement are true and fair. So then the shareholder will be thinking, okay, look, in the planning stage they were quite skeptical, and they did too much work. They were having all those risks in their mind, and then they checked it as well. That is why they are giving us the unmodified opinion. Similarly, items based on judgment within the financial statements. So like the shareholders are also concerned regarding those items which are based on the judgments, such as provisions. So we are telling them, okay, look, in the financial statement, these are the things which are based on the judgments: allowances, provision, fair values, estimates, blah blah blah. So indirectly we are telling them, look, we have also seen the items which are based on judgments, and indirectly we are saying to them, we have also confirmed the reasonableness of those estimates. Although we'll not be writing this thing, but indirectly we are saying this thing. The third thing is major event or events occurred during the year. Now the shareholders are also concerned that if there are some events which occur during the year, they need some special attention on that. For example, there was some restructuring, reorganization, they bought a subsidiary, they sold a subsidiary, they did mergers, acquisition, whatever, blah, blah, blah. So we will be telling the shareholders, look, these were the major events during the year. So now, if you look at these information that we are giving to the shareholders in the form of CAM, the risk of material misstatements, items based on the judgments, major event occurs during the year. So the shareholder will have too much information. that, okay, look, the auditor has done some substantial work and the opinion is based on the that substantial amount of work they have done on the financial statements. So they will feel more comfortable, they will feel more informative, and obviously they will be believing that, okay, that your conclusion is actually not something normal and you have done some good efforts on it. So these are the things we will be explaining in the key audit matters. Now, if you are having the question in your mind that key audit matter is also giving the information to the shareholders, and we discuss in the emphasis of matter paragraph as well that we are putting some information for the shareholder. Now, what is actually the difference between CAM, key audit matters, and emphasis of matter paragraph? So if this is the question in your mind, this is a valid question. First of all, CAM does not constitute any modification. With the inclusion of CAM, the opinion and report remains unmodified. And when you talk about the EOM, emphasis of matter paragraph, report is modified. This is the first difference. The second, CAM is part of unmodified report. This is not something the wish of the auditor. CAM is part of unmodified report. And this is at auditor's discretion. If auditors think that there should be an emphasis of matter paragraph, he will be including that. So this is the second difference. Now, one more thing is, if anything which has already been discussed by CAM, then there is no need of emphasis of matter paragraph. If something has already been discussed in the CAM, because the CAM is, covering three major things: risk of material misstatements, items based on judgments, major events occur during the year. That means now somehow there is no need of emphasis of matter paragraph. But still, if anything which is covered by the CAM, there is no need of the emphasis of matter paragraph. All right, so now we are continuing from the other parts of the report. In the previous session, we discussed the difference between the CAM and the emphasis of matter paragraph. Now, let's come towards modifications. Now, let's come towards modification. I told you that when you talk about the modified report or the modified opinions, so there are three modified opinions. Let me just scroll up and show you. Where is that? Yeah, this one. Qualified opinion, adverse opinion, and disclaimer of opinion. So these three are the modified opinions. So now, qualified opinion, that you are saying except for this, whatever that is the case, rest of the financial statement gives the true and fair view. Adverse opinion, financial statement do not give a true and fair view, and this is the overall opinion. And disclaimer of opinion, that we are unable to express any opinion, so we are not giving any opinion at all. Sometimes students think that we are just denying them, that we are not giving any report. We are giving them the report, but in the report we are writing that we are unable to express the opinion. We are not giving any opinion. Now, how are we gonna establish these modified opinions? How? You are going to decide between modified opinions. Now, the question here is that when you will be giving the qualified opinion, when you will be giving the adverse opinion, when you will be giving the disclaimer of opinion. So in order to understand that, the first thing you need to do is to understand the difference between material and pervasive. Material and pervasive. Now, first of all, let me just describe these two in the plain wordings, leave the audit terminologies. When you talk about material is something significant. That is why we call that thing as material. Material is something significant. Material and pervasive is a higher degree than material. So you can say too significant. So material is also a significant thing, but material and pervasive is a higher degree than that. Like for example, if someone say I'm stressed, and if someone says I'm too much stressed. So the difference between the stress and too much stressed is the difference between the level of these two stress. So material is also something significant, but material and pervasive is a higher level of that, it's a higher degree of that. Now, how are we going to decide that whether something is material or material and pervasive? Now, the basic difference is simply if something affects financial statement as a whole, like say for example, if you're looking at the financial statements and you see the impairment is not recorded, even the inventory is not recorded at load of cost or NRV, the fair values and incorrect estimates are not reasonable, that means there are multiple misstatements within the financial statements. And when you club all those financial when you club all those material misstatements, sorry, that becomes a very significant amount. So financial statement as a whole is affected. Then you're going to call that material, sorry, and pervasive. But if something affects a particular balance or balances, but not the financial statement as a whole, or you can say, sorry, or for example, you say that something is at the assertion level, that is affecting a particular balance or balances, but not the financial statement as a whole. Then you're going to call that material, not financial statement as a whole. So remember what I said, that when you see that something is affecting financial statement as a whole, there are multiple material misstatements, and when you club that, it affects the financial statement as a whole. Significant effect is created. And if there is a particular balance which is misstated, which does not affect financial statement as a whole, then we'll be calling that material, but not material and pervasive. This is the simplest difference. Now, we also discussed that the materiality levels, and we said that three things. In the last topic, we also discussed that when we were discussing the matters. So there are three benchmarks: profit, asset, and revenue. Profit 5% or more. Assets 1% or more. And revenue is 0.5% or more. So an item is said to be material if it is 5% or more of profit, 1% or more of total assets, or of the revenue. These are the three things we need to see. So this is for the materiality level. In order to classify something as material, we need to see these benchmarks. Now you will easily understand how we can give the opinion. So first of all, you see material, whether something is material or material and pervasive, which is a higher degree. Then you're going to see that when you are doing the audit, there may be either the material misstatement within the financial statements, and the material misstatement means that something is not correctly recorded according to the standards. The other thing is, insufficient audit evidence. So when you are doing the audit, there can be two problems. Either there's a material misstatement within the financial statements, that means something is not recorded according to the standard, or you are unable to gather evidence, that is insufficient audit evidence. So if there is a material misstatement and a fact is material, like there's a material misstatement, something is not according to the standard, and that is a particular balance or balances. For example, inventory is not correctly recorded at the correct NRV. So only inventory is affected. So what should be your opinion? Qualified. That except for the inventory, rest of the financial statement gives a true and fair view. But if there are material misstatements and the fact is material and pervasive, that means financial statement as a whole is affected by that, then we will be giving adverse opinion. That means financial statements do not give a true and fair view. Similarly, when you are unable to gather the evidence or there is insufficient evidence regarding a particular balance or balances, for example, you were unable to gather the evidence on the receivables because the evidence got corrupted. They are saying we do not have the receivable ledger due to the virus, for example. So we'll be saying, okay, except for the receivables, rest of the financial statement gives a true and fair view. But when they are unable to provide you the evidence regarding the revenue, receivables, payables, purchases, non-contested, and there are so many things in which you are unable to gather the evidence, and that makes the financial statements affected as a whole, and the effect is material and pervasive. So you will be giving the disclaimer of opinion. So qualified opinion, adverse opinion, and disclaimer. So this is how. All right, so last thing is to complete this going concern report implications. And when we are dealing with the going concern report implications, there are four things you need to understand. The first thing is, if the entity is a going concern but a material uncertainty exists and that it disclosed, then there is no need to modify the opinion because everything is fine, and even the report will remain unmodified. So what we'll be doing, we'll be including a para in the unmodified report which explains the material uncertainty. And if there is a material uncertainty which is not disclosed, then if the matter is material but not pervasive, the qualified opinion will be given, that we'll be saying except for the going concern, rest of the financial statement gives the true and fair view, and except for the material uncertainty related to the going concern, rest of the financial statement gives the true and fair view. And if the matter is material and pervasive, that means it affects, that this material uncertainty affects the overall financial statements, if the matter is too much significant, then we'll be giving the adverse opinion. That means financial statements are not true and fair. If the complete assumption is inappropriate, that means they are not a going concern, but they still have made the financial statement on the going concern basis, then the adverse opinion will be given. And the fourth case is that the auditor feel that the evidence regarding the going concern assumption is insufficient. On the basis of that, they cannot reach the opinion whether or not the entity is a going concern. So if the matter is material but not pervasive, qualified opinion will be given, and that again means that except for the going concern, rest of the financial statement gives the true and fair view. And if the matter is material and pervasive, then we'll be giving the disclaimer of opinion. That means we are not able to make to comment, we are not able to make any opinion, we are not able to give any opinion. So this is the going concern report implications.